Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Matt Medrano. He is the managing partner and CRO of Dynamo Capital, a private lending group that's based in Kansas. It specializes in both short-term rehab loans and long-term DSCR financing. With a background in economics, real estate, and commercial lending, Matt has built a multi-million-dollar pipeline while helping investors access flexible capital solutions outside their traditional channels. Dynamo Capital has also become the #1 private lender in Kansas and has currently 30+% of the market share. So congratulations on that, Matt. I am looking forward to jumping into everything financing with you.
Yeah, man, let's get into it. I love talking about it. It's not a particularly sexy topic, mortgages.
Right.
I geek out over it. I like it. I think the core of it is, the help that you're providing our borrowers and the community in terms of revitalization that gets most exciting. But yeah, let's go for it.
Sounds good. So I always like to begin, Matt, with really your background, where you grew up and what eventually led you to get into, this type of financing.
Yeah. So, easy background story. I mean, I'm from Wichita, Kansas, born and raised here. I went off to school at Grinnell, Iowa, in central Iowa, between Des Moines and Iowa City. Came back home from college and started working the next day after graduation at Koch Industries. So Koch, not Coke and Pepsi, but Koch Industries is in the Koch brothers. Headquarters is here in Wichita. They're Wichita guys. In fact, Koch's house is right around the corner from our office here. I mean, it's just kind of interesting the exposure and access you have to really high net worth individuals here in Wichita, which is kind of like one of the secret sauces of Wichita. It's a sneakily affluent area. With a really good workforce population still. We have, we're the air capital of the world. So virtually every airplane manufacturer, the big logos that you'd recognize, has a plant here in Wichita. So it gives us a really good blend of, one, the community and the people that you have in terms of, really strong financials, and then also a really good workforce. And so it gives rise to a really strong real estate market. From an investment and a rental perspective. So kind of plays nicely for what we do.
Yeah.
I stayed at Koch for, like 2 months. I knew on day 2 it wasn't for me. I fell asleep on my first day, kind of on accident. I came in after Memorial Day, and my direct boss wasn't there. My HR manager that hired me wasn't there. And they kind of forgot about me because I accepted my offer back in October. It's such a big operation that they're hiring so far in advance. And I don't know if it just got caught in my spam or it didn't get to me or whatever. The QR code to get into the campus up there I didn't get, so stuck at the guards gate until like 11 o'clock before they could validate who I was. It's a very secure location and whatnot. Finally got in, and they of course didn't have anything for me because they weren't expecting me. So I was a 300-pound defensive tackle in college, and I had gone keto. And if you've ever done any of that type of stuff, you know that a carb is pretty much like taking an Ambien. And yeah, since
Yeah.
the end of football season, I hadn't had any carbs whatsoever. I was just totally dedicated to, I can't be 300 pounds anymore, so I got to do something. I don't have an excuse to be anymore. And so I wanted to be a normal guy at lunch. I ate a roll with my salad for whatever reason, as if, people would know that I wasn't a normal guy or that I was on some weird diet by not eating the roll. And within 30 minutes of being back at my desk, I was face first in Charles Koch's book, Good Profit, to pass the time. And yeah, it was an auspicious start there. But ultimately what I realized was, I'm not a financial analyst, monthly reporting guy. I want to be in the mix of things. I want to be making meaningful changes. And ultimately, Coke's one of the largest companies in the country. I couldn't affect real change from the seat that I was in until I had matured a lot there. And I struggled with that right away. And I just knew that it wasn't the fit for me. So I wound up moving into IT enterprise sales. There's a really good consulting company here in town that I went to, found really good success there. But ultimately, that got bought by a larger, hedge fund. And I was the young guy on staff. Of course, I was going to get cut. I kind of saw the writing on the wall there. I moved into the foundation space here in Wichita. We have a really expansive and messy clay soil. It caused a lot of damage to foundations. So that's a really strong market here. I didn't know anything about basements. I didn't know anything about, waterproofing and wall repairs and settlement and all those things. Through the crash course there, found that I really liked direct sales. And started building relationships in my community with real estate agents and investors in the real estate game, who were doing projects that required foundation repair. And like I said, I was a defensive tackle. I don't fit in the crawl spaces. Our frost line is 36 inches, so crawl spaces are not super deep here, but they're pretty common. I don't like bugs and critters either, which are also very common in that line of work.
Right.
I found I was really good at it from a relationship building and networking perspective, but ultimately it just wasn't fulfilling to me. And it was a good source of income. We were pregnant with our second kid, Blair, and I knew if I was ever going to make a change that I needed to do it right away. Before I got it's so hard when you have, not just you and your wife's mouth to feed, but also, kids. And so I felt the pressure of the first one. It was really good job that I had, but ultimately I wasn't fulfilled. And it was really important that I was, not just making money, but also, fulfilled and happy with what I was doing. And so, it was around COVID. I had refinanced my house with my now business partner, Justin. He was a residential mortgage broker at the time and had a really good rate. And I realized at the time, let's back up a little bit, there was a lot of equity locked up in houses. There was higher rates that they had on them, or good rates at the time. And they were 4s and 5s. They weren't bad by any stretch of the imagination from a historical perspective, but you could get into the dang near the 1s and 2s at the time. And there's a lot of opportunity for me to send my clients who needed $20,000, $30,000, $40,000 worth of work to Justin, refinance, reduce their rate. Sure, they reset their amortization schedule, but they had a much lower rate. They had the equity pull out that they could get the repair project done with. My project was funded. Justin did a mortgage. All three of us won. It was a good relationship and a network that we worked on. I did some of the repairs for, the things that would come up on his appraisal reviews and stuff that needed work. And it was just a really symbiotic relationship. We had kind of always flirted about me coming over to the mortgage business, but I could never pull the trigger because it's so commission based and no base pay. And I just was so risk averse to that, especially starting the second part of the family. I wound up rage quitting my one day because I despise do as I say leadership, and that's kind of what I was fighting. And great boss that I worked with, but ultimately I wasn't able to work direct with him anymore. And I just said, this is the time. And my wife and I kind of had a conversation. The next thing I know, I'm texting Justin saying, "Hey, I just ordered the mortgage licensing test. Tell me when I start." Of course, I went about that backwards, but here we are, and it's been the right move ever since. So He also convinced me rates were going to be 2% for the rest of my career. So my license cleared top of 22. And then, we started a hockey stick back up from there. So I sold the 2s and 3s. Then I sold, I guess if we have any younger listeners, the 6, 7s in the rates world. I sold the 6, 7s for a while. But I had all these investor clients that would still have me ask me to look at their foundations, but they were asking me about funding. How can we do loans together? Fannie and Freddie traditionally don't have good products for this. If you're a prolific investor, you're capped at 10. It's difficult to, show good, strong income on your, if you get an accountant that's working for you, right? He's usually hurting you from a W-2 or from a tax perspective. It's really tough to cobble together a prolific business owner and self-starter, and then the Fannie Freddie guidelines. And so, we naturally tried to do some of those loans. It was difficult. We found creative workarounds, whether we refinance a primary and pull the cash out there for you to go do something. But ultimately, that's not sustainable. So we jumped into finding the traditional commercial mortgage brokering options. And I say commercial loosely, really just non-owner occupied stuff in my context.
Okay.
Especially coming from the Fannie Freddie world where it's all primaries pretty much. So the Kiavis, the Lending ones, the Lima ones, kind of all the standard, big box store players that you'd recognize. So we started brokering to them and immediately recognized a hole in our market. First off, we were really the only mortgage brokers in the space in Wichita. That's pretty common on the coasts, but in the Midwest, we're dominated by local banks and credit unions. Traditional retail mortgage shops are what you typically see. Brokers are fewer and far between. So, as the credit unions and banks started to get less heavy on commercial real estate or really mortgage loans in general, because they had so much 2% coupon out there, a lot of them jacked their rates up to points where they priced themselves out. And so, me having a 30-year fixed option through Kiavi or whomever, we were the belle of the ball for liquidity in the real estate business. And so we started brokering these loans. But where we made a mistake was we conflated commercial lending to traditional guidelines like Fannie and Freddie have for USDA, VA, and FHA. If I check the box and I get under the VA, the DTI requirements, if I, have the eligibility for a VA loan, et cetera, as long as I check all those boxes, the VA's got to show up and give me the money for the loan. Right. That's not the same thing in the commercial world. Ultimately, if, that lender doesn't like the deal, they won't do it. And so, for example, in the DSCR business in Wichita, you can still get $120,000 rental here. And it's a really nice rental for like the class of property that it is. Produces good income. The 1% rule still applies here. We had really strong DSCRs, right? And effectively your DSCR ratio becomes the DTI of the commercial world for all intents and purposes, right? It's the thing that you're always trying to do gymnastics to make work. We have to do gymnastics here. We have really strong rentals, rental rates, and smaller loan amounts. So the DSCR really works, AKA cash flow is nice here in Wichita. And we have really good, consistent renters that, pay, and that's just kind of the spirit of Wichita. So it was a very attractive deal on paper, always. And our account executive that covered for each of our, different shops, they were never really even in our time zone. They were either in, maybe we got somebody out of Ohio, maybe we got lucky and somebody from Denver was covering the Wichita area, the Midwest. But generally speaking, nobody was ever even in our time zone. Because the Midwest is pretty devoid of this type of lending activity. So, as such, we would get passed over a lot, or at the goal line, a loan that on paper works, and we've told the borrower, hey, this deal works, we've got an approval from the lender, et cetera, et cetera. It goes through final review or whatever second underwrite happens at the bigger shop, and then they don't like it for whatever reason. They got the picture of the property, they finally look at the appraisal, because you don't really underwrite those deals until the full package is there in the commercial world.
Yeah.
The appraisal is usually the last thing to get there, and then all of a sudden they don't like something. Well, to the lender, they're protecting themselves. They don't like it for whatever reason. They move on. I still have to go back to the borrower and say, hey, I know we're closing tomorrow, but we're not closing.
Yeah.
And
Yeah.
Wichita's a small place. You can't do that, right? Like, and also, personally, if I say I'm going to do something and I say I can commit something, then I have to go do that. And so out of frustration, the only way to fix this problem is to raise our own fund. So we started in 2023, September of 2023, we started the fund named Dynamo Capital and started doing our first few loans. We did about 20 loans in a kind of call it beta test mode.
Yeah.
Because we were brokers before. We never, serviced a loan or, recorded mortgages or did any of that stuff. That was all taken care of. So we knew the first thing about underwriting and, setting up guidelines and stuff like that and, sizing deals. But we didn't know the first thing about any of the rest of what it means to run a lender shop. So we had to kind of do a beta test, figure that out. We worked with borrowers that we know, liked, and trust. That gave us some grace for us to figure out how to run a shop. We took those lessons and applied them. We do short 6-month loans. So we had a very obvious, test period for us to work through. And then we had figured out enough information that we felt like we could go out and apply the changes. And we started taking on our first capital in April of 24. Our first real fundraising capital goals were starting to hit in 2024. By the end of 20. Yeah, it's a combination of both. So Justin and I rubbed a couple of nickels together and we put everything that we had together. There was friends and family from there. We did have
Okay.
a capital partner, which is a bigger lender that we had brokered stuff to in the past, who was a participation partner that was going to be a 90-10 partnership. So they would fund 90% of
nice.
it. We would fund 10. So for $1 million pipeline, Dynamo needed to spend $100,000. And then the partner was going to fill in the other 900. Ultimately, they had a liquidity event right around our first week of funding together. Even then, we really didn't know what a liquidity event meant, AKA they weren't going to give us any more money. And so we had about $1 million in our pipeline lined up on that first go around. And we had to find the other 900,000. We pushed all $100,000 in the middle for us. But luckily back to Wichita, kind of saved us. We were able to call around, explain what we were doing. Ultimately, we didn't drop any of those fundings. We hit them. It was a big deal for us, but we ultimately should have been strangled in the crib. But the big takeaway for us is that, how do we grow and insulate ourselves from anything outside of our walls impacting us? And control our own destiny was a huge thing for us. Our original plan was to raise $5 million from retail investors. That would give us $50 million worth of lending capacity. And we thought that was plenty to cover Wichita. That was our initial kind of value prop and original thesis. And what we found pretty quickly was, we can't rely on anybody else. Right, wrong, or indifferent. We just weren't going to allow ourselves to rely on anybody else. And that liquidity event really forced us to grow probably 5 years and 5 days in our first 5 days, right? Because we were going to just kind of conservatively grow this and work with our partner. And then eventually we'd have enough war chest to go, okay, now we can do this on our own. We decided right there, we made a pact to ourselves, not let this happen again and, figure out how we do this on our own. So we got much more aggressive in how we were capital raising. It just changed our entire outlook on how we were going to go about doing business. And ultimately, it was wound up being the best thing for us. At the time, felt like, our life was over and the business was dead and all those things. It was a very dark time. And any business owner can relate to those periods that you go through.
For sure.
But it was a particularly dark one. I got quite a bit more gray from it. Good lesson learned. I'm glad we learned it. At the time, I hated it. But I look back on those kind of foxhole moments that Justin and I had is, really galvanizing, our both partnership and friendship, because ultimately it was on both of our backs to figure it out. And we didn't have anybody else to get us through that. It was up to us. So that was a good life lesson for us to go through, though.
And what year was that? Right when you were kind of having to figure that piece of the puzzle out?
23 is when we had the liquidity event with our capital partner, right as we were starting. Okay. So, there's 23 a lot of lessons
too. At the end of 23, correct me if my timeline is wrong here, but at the end of 23 is when rates started really going up as well, right?
Yeah. I mean, it was 22 to 23. I mean, it's kind of all a blur in my head on this point with the rates.
Yeah.
Generally speaking, we're fairly insulated from what the traditional rate is in our world.
Mm-hmm. For sure.
So I think that's a big misconception. You get a lot of questions now, especially now that we're doing more DSCR business, is like, hey, I saw the Fed change the rates here or there. Like, cool, does not matter to us, right? We're in a completely different pool of capital. Mm-hmm. Now, ultimately, it signals market sentiment and all those things, but it's not a one-to-one change, it's just totally different pools of capital.
Wealth Flow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. Yeah. No, I gotcha. I just, with a lot of your customers or potential customers being investors that are fixing and flipping, when they're putting it, if they're not, buy and hold, and they're not, just basically doing a BRRRR strategy, but they want to ultimately put that property back on the market, then that's when the rates going up, could potentially affect who they're going to end up selling it to. And
totally,
that's slowed the market down. Yeah,
absolutely. That's why particularly coming out of COVID, I think everybody, whether they were essential or not, right? People started to realize I have to produce income outside of, my daily W-2. And so, I want to, what does everybody need? Everybody needs a house. I mean, even when we were locked down, we were shoved in houses, right? And you still got to make those mortgages. We saw people rushing to build portfolios, it was weekend warriors that now had more time and I can, I'm pretty handy. I can do some of these repairs on my own and, work through it or whatnot. You saw a lot of people jump in to build and scale quickly. Mm-hmm. And that's when we were brokering loans to the traditional partners, we saw the main question we always got was, can you get me more leverage? Traditionally, fix and flip lending, if you're going to the bigger box stores, loan to cost stuff is capped at 85, 90, maybe get to 95 is some of the most aggressive stuff you see. Of course, there were a couple 100% lenders, but nothing at meaningful scale. And so, in our market, 5 or 10% down really means $10,000. And that's ultimately not changing too much of the equation for us. So for us, we could provide a gigantic benefit to a client by funding 100% of the loan and taking on slightly marginal risk by increasing the loan to cost to that 100%. And it's so much more attractive. And so what we did was we focused on 100% loan to cost loans. In practice, our book is, there's quite a bit of day one equity that these clients are bringing in. So even though we're lending 100% of the loan or 100% of the cost, there's still quite a bit of value on day one because our clients are buying good deals. Whether it's 80 or 90%, they've got it or 10 or 20% skin in the game just from the equity that they're buying on the discount. But, we position ourselves as a scale-friendly lender. At the end of the day, what Dynamo Capital sells is the ability to scale and scale quickly. By being able to stretch your dollar further across multiple projects. And to your point, as rates got a little bit haywire or even more haywire and there was uncertainty and buyers on the primary market slowed down, enter, a client needing to get out of it and flip it into a rental. Because the good news about what we do here is I'm not super concerned what the primary market is doing, because if rates go to 10 tomorrow and we become more of a rental society or even more of a rental society and then we're trending, then we're going to do more DSCR loans.
Right.
If rates plummet to 2 tomorrow, then boom, I've got a lot more buyers. My flips are going to wind up being more flips as opposed to flip and hold, or to rehab and hold. So we have a lot of flexibility here. Dynamo's job is to shift the amount of the type of loans that we're doing based on what the market's calling for. So we've seen in our market, particularly in Wichita, we've seen a lot more DSCR business as our clients are refinancing out of the rehabs into long-term holds, and they're just shifting their strategy. When we size a short-term loan, we size it to be able to do either, right? Of course, you can go sell it, and those deals make sense all day, but all of our short-term debt can refinance in the long-term debt without an equity injection. That's like a main underwriting guide of everything that we do. Yeah. Our generally speaking, our short-term debt is 100% loan to cost, not to exceed 75% LTV. We didn't rewrite the book on how to do that, but the theory behind why we capped at 75 LTV is I know I can always go rate and term that business immediately on the long-term side and get some payment reduction for my client.
Yeah, no, makes a lot of sense. And that's a good, from an investor standpoint, it's great to have that ability. If you get to a spot and you're not able to execute that initial business plan of selling it on the market, you can just put a tenant in there and hold it.
Right.
So,
right.
Maybe for the audience, Matt, could you talk a little bit about, a DSCR loan? I know a lot of the audience knows what they are, but it's a unique product, and the fact that you got 30-year on up to 10 units, has that changed, or is that about the same as?
No, that's the same. Yeah. I mean, it's out there. I mean, that's what we do. So DSCR at a high level, I mean, I'll spell it out. It's debt service coverage ratio. And it's exactly what it sounds like. How is the monthly income from the property or proposed monthly income from the property going to cover the proposed monthly payment of the loan? AKA cash flow of the loan is really what that ratio comes out to be. Right. So it's a pretty basic equation where you're going to take the gross income of the property over the full PIDIA payment that you have for the potential loan that you're looking at. That's going to give you a ratio. Obviously, you want to be north of 1. There are times when south of 1 makes sense. It's fewer and far between, but we will go down to 0.75. That's a fairly common guideline that you'll see in the DSCR lending space. Very few and far between. You've got to have a reason for it, and otherwise it doesn't quite make sense. But there are times when it does. Obviously, you want to be north of 1 because you're making money at that point. But the golden target is that 1.15 to 1.25. It's very, the good news about the Midwest market is you can still get strong DSCRs that are north of that number pretty consistently. It's not a cash flow constrained market like you might see on the coasts where it's more aggressive and DSCRs are harder to come by. DSCR lending got much tougher as rates went up, obviously, because it shifts the ratio equation dramatically. So it's really key to do things like stretching out the amortization to 30 years. I mean, for example, in Wichita, cash flow was very difficult to come by because the local banks and credit unions somewhere along the way had a secret meeting and agreed that a 20-year AM was a good deal. And then all the borrowers in Wichita agreed that was going to be the thing. So obviously banks like shorter term loans from that perspective because you're cycling the capital a little bit more, I guess. But for us, representing the investors, I mean, I probably have investors that take a 50-year DSCR if they could, just to make cash
Yeah,
flow
for
work
sure.
right now. But the 30-year made us very attractive. And so most of our deals work on a 30-year. I mean, we don't have to do too much gymnastics to get the DSCRs to a workable range. And to be honest with you, a lot of people have access to the DSCR product. It's fairly commoditized. There are tons of lenders that do it. And generally speaking, it's going to all wind up in the, one of the same like 6 buckets. It's either going to get securitized here with this partner. It's going to securitize with that partner. It's going to wind up in this pension fund or that pension fund. They're all going generally to the same place. They're not new to the market per se. I find myself explaining what DSCR is a lot more lately because people are getting more wise to it. But I'm still surprised by how many people are still unaware of the DSCR product. So that's one of the reasons that we're doing this, just to get the word out on it. But generally speaking, it's all going to the same sources of liquidity. It's a very consistent real estate investment product or credit product that you can get into, and so a lot of fund managers and whatnot want to invest in it. So the real differentiating factor from a DSCR lending perspective is the originator of that loan. How willing to work through, what are fairly specific guides in the DSCR space. How willing is your originator to, work through those guides, find ways to make deals work? For example, like a very common threshold in the DSCR space is that the unit needs to be at least 600 square foot. Very common, edge of a box that you'll see. Are there, if the appraisal comes in at $599, technically that's outside the box. How aggressive is your lender in, arguing to their credit partner and their provider that, hey, this $599, let's round this up to $600 and let's be done with it. A lot of lenders will say it's outside the box, we won't touch it, right? One of the things that we focus on here at Dynamo is going to bat for our client, being their best advocate, and ultimately, making a case as to why this $599 square foot, which is, once, and we can talk about like a edge case like this. These are real things that happen. I mean, we had I think it was a 596 that we were dealing with. Technically that's unlendable. But it's about having good relationships with our partners who we're going to be, trading this loan to in the background. I'm going like, hey, this is a 596. We're going to show you the hair on it. But here are all the compensating factors of why this is a good deal and why you should still take it and move it into your box. And then ultimately, those relationships pay off and they take those things and we're able to do a deal for a client that was technically undoable, maybe on the first 2 tries they had with the previous lender. So we also try to be really transparent about what's happening in the DSCR world. A lot of times it's a black box of, what's happening behind the scenes. And, we're not shy about how we manage our money here at the fund. I mean, from an RTL perspective or a short-term bridge loan perspective, we're 100% a balance sheet lender, meaning it's Dynamo Capital's money. We decide what we want to do with it. We're not subject to any guides or anything along those lines. It is our thumbs up, thumbs down if we want to do a deal. And it's how we create our return. On the DSCR front, we do not want to hold 30-year paper at the, very attractive 6% rates that we're handing out today. And those are real rates. I mean, we're pricing everything, generally speaking, case by case. On DSCR is a really hard matrix, but generally speaking, a lot of stuff is coming out in the low 6s to mid 6s, which is very, very sharp in terms of pricing. But we don't, the fund doesn't make money holding those 30-year notes. Right now, we take those loans and we trade them into the secondary market, just like you'd see in a bank or any of these other bigger lenders.
Are you trading those like individually into the secondary market, or are you bundling them up, or how are you?
So, as actually, no one ever asked about the capital markets component of this. We have relationships where essentially you trade them to a partner down the line. They know what you're putting out on a monthly basis. They have a ballpark of what you're doing, and then they take them from us. So we'll probably trade 10 loans at a time to those partners.
Okay.
We're not big, like in some of the bigger shops, they'll aggregate a bunch of loans, and then they'll put them out on the market and say, okay, I've got this pool. Give me your best price. Give me your best price. We'll take the best price out of it and move on. We work with specific partners that we're making sure that our guidelines are in line, that they like what we're putting out, and then we trade them off to them. So it's a good way for us to manage our risk from the DSCR perspective at the fund, but also provide another outlet for our clients to be able to get out of these deals. So, yeah. That's
From an investor standpoint, kind of sticking on the DSCR, what are so from a qualification standpoint, you mentioned the debt service coverage ratio, but the independent borrower themselves, what kind of qualifications are you looking at with respect to them?
Yeah, so it'll feel pretty traditional mortgage, but in a lot of ways, it's not. I mean, I'm not interested in your tax returns. I'm not interested in your W-2s. We are purely interested in what the asset does itself, right? How does the asset perform under this new mortgage? What'll feel traditional about the underwriting process is we got to get all your documentation from, operating agreement, your EIN, all the basic stuff about the property. We have to go through a traditional appraisal. That's very common in the DSCR world. Almost everything's on a traditional appraisal. So that feels very residential in that capacity, where like my example on our short-term stuff, we don't always require appraisals or rarely require a full 1004 appraisal. So that's a little bit of a different world. DSCR though, a lot of it's driven by credit score. The difficulty in DSCR pricing is everything's about buckets. So if you're in the, 620 to 640 bucket, you're going to have a pricing adjustment there. If you're in the 641 to 660 bucket, you're in this price adjustment, et cetera, et cetera. So, the pricing on that stuff moves around. And I think the biggest downfall of DSCR and like the qualification piece that everybody should understand, similar to the residential world, if you're looking at a contract price versus a value, the appraisal price, you take the lesser of the two is what your loan is based on. No different in the DSCR world. Not only are we looking at the value versus if it's a purchase to contract price, you're also looking at what your market rent is versus what you have it leased at. We take the lesser of the two. The lesser of the two falls into that equation for the DSCR. So what can be confusing for borrowers is let's say you have a tenant that's leasing at $2,000 a month, and your cash flow is great. You got $1,000 a month mortgage on it. I mean, that DSCR is 2 by definition under that. But let's say the market rent is actually $1,500, right? The appraiser comes out and says it's $1,500. That's what you have. You have a really good borrower that loves this property, that's willing to overpay according to the market and is in there for $2,000. If you run your DSCR numbers as the borrower internally, and you base it off of $2,000 because that's what you're getting rent for, then you're going to be in for a rude awakening when we adjust the DSCR. Now, in this case, both of those work. 1,500 on 1,000 or 2,000 on 1,000 is still a good DSCR ratio, but that equation can get tougher if market rent comes in light, because ultimately the lender is looking at it from their perspective. I can't always trust that this tenant's going to be here overpaying at $2,000 a month. And if I have to take it back, I have to trust whatever's going to come in on market whenever I take it back. And so if I can't rent it for the $2,000 that makes this deal attractive, then I have to size according to what's actually going to be reasonable coming in. So that, from a qualification perspective, it's just a math equation about making that DSCR work. And so understanding the actual components that go into the DSCR ratio is the biggest deal from a qualification perspective. Other than that, like, you're checking a lot of boxes as a borrower, background check and stuff like that. We're not too tied up in the specifics of the borrower per se.
That's kind of what I was hoping to get at too. Is you have investors listening, right? And it's a lot of times, especially real estate, folks are going to try to eliminate as much income as they can. Traditional borrowing may be a little bit of a difficulty if they're not showing enough income. And you know, I don't know if you look at like personal financial statements, that kind of thing as well, or anything, or if it's just solely off of
no, generally no. I mean, it's asset-based lending. I think that's the core of what everything that we try to do here is. So, you know, we don't typically push for a PFS or anything along those lines. I mean, it's, you know, we want to, ultimately these are loans done to an LLC. You know, they're signed and guaranteed by a warm body at the end of the day, but our borrower itself is a corporation, which is, you know, I'm not a lawyer, so I won't go through all the details there, but it gives you some, you know, level of safety there. But yeah, I mean, qualification's not hard. I mean, it's all about the property. The difficulty and what a lot of people be frustrated about by DSCR is it's a lot of hurry up and wait. You're waiting on third parties. You're waiting on the appraisal, and the appraiser handles so much control in the DSCR business. And ultimately, you know, the lender will get blamed for a bad appraisal, but we have nothing to do with it. We're a distant third party. We go through AMCs. We don't have control over the appraiser. If the appraiser wants to correct the market, and they oftentimes do, you know, they'll say what they want to say. Now, it's on Dynamo and other DSCR lenders' plate to go back and advocate as to why your $2,000 a month rent is actually market rent, and, you know, fight that case for you. And that's what separates a Dynamo from other DSCR lenders is we're very, very interested in fighting that case for you, and, you know, ultimately being your best advocate. Because we want to do it for you too. We don't want to not. I mean, you know, I think a misconception in the lending world is that the lender doesn't want to do the deal. I can assure you that everybody out here that's putting work in to get these deals done wants to see them go through the finish line. One big thing about Dynamo, we don't pay any per file basis payment out there, so no one is compensated to get a file, across the finish line. They just genuinely care about the work they're doing and wanting to get, you know, you work on a file for 20 days just for an appraiser to blow it up at the end. You know, it sucks for everybody. It sucks for the borrower who needed liquidity. Yeah. They wanted out of it. It sucks for my processors and underwriters that have, you know, spent 2-3 hours on that deal, you know, cumulatively over the couple of days that they've been working on each of those files, and they can't get that back. You know, and so, you know, they want to serve everybody. We're really aligned. It's one of the toughest selling points of my job is that, you know, we're not only are we we're a private debt fund, we're a credit fund, but we're altruistic and we want to do the right thing. Usually, you know, private credit, private equity, those, you know, hedge fund type character names, they don't usually come with positive connotations, and you know, we're fighting the good fight to change that.
Yeah, that makes sense. How about tell me a little bit about the short-term kind of fix and flip type loans? You know, what kind of just the basics of what does that look like? How long is the term typically on that? And then again, kind of from a qualification standpoint, what are you looking at from that borrower?
So qualification-wise, again, it's asset-based lending. By example, we don't have a minimum credit score. It's all nuanced. Common sense underwriting is the main thing that we're trying to do. We have, of course, guidelines that we try to follow, and that, you know, we have, you know, a scaffolding for us to work through. But yeah, I mean, high level, we're, like I said earlier, we're 100% loan to cost up to 75% LTV. So what that means in practice, I'll give you a common example. You can buy a property for $100,000. That still happens here in Wichita. You're going to put $50,000 into it. It's going to be worth $200,000 when you're all said and done. Dynamo Capital is not only willing, but happy to lend you $150,000 to do that entire project. That represents the entire need or cost for your loan, aka the 100%, because it doesn't exceed 75% of the 200, aka 150. It's the same. It's the perfect scenario. Traditionally, we charge, you know, origination fee against that, and then an annual interest rate. Anecdotally, here in Wichita, our market's a little bit funky in terms of what the pricing schedule looks like. We charge traditionally 3 points in origination, 12% annualized rate. we're competing against some lenders that are charging no points and 36% annualized rate. So 0 and 36 versus our 3 and 12. We're on the sharp end of the private lending pricing from a 100% loan to cost lender as well. But ultimately, costs aside, what we become is an equity-free equity partner for clients. When we moved into the Denver market, it's a more mature market. There's a lot more national players with, frankly, sharper pricing, but way less sharp loan terms in terms of leverage. So the cheapest money you're going to find in the short-term bridge lending space is maybe a point and a half, and the 9-10 range, 9 for sure, rate. If you're a really well-qualified borrower and you fit a, more institutional style box for the RTL loans. But you're going to be capped at 85 LTC, 90 LTC. You're not going to see those LTCs creep up. And so a lot of our borrowers, especially in the Denver market, we have a phenomenal loan officer in the Denver market, who was coming from an institutional style lender. And, she had been always competing on a race to the bottom type of pricing structure. But those clients with the 10, 15% down requirement were going out and find equity partners that were costing significant amounts of equity into their project. And so what Dynamo represented was, sure, a slightly higher cost from origination fee and rate perspective, but no stress to find equity partners, and ultimately no loss of return, which they had to give up, to sometimes to the tune of 50% of their equity. We're not interested in any equity in those projects. We don't want to be an equity fund. We're a credit fund. You will have everything you need to complete a project from us, so long as the deal makes sense, of course, all those things. Let's just assume both boxes are checked. You keep all the equity that you earned. And so when we become an equity-free equity partner, we become very, very affordable compared to, a traditional lender plus an equity partner on top. If you just look at total, return on cash, no money down is a pretty infinite hack to return on cash. And that's where we position ourselves in the market. So, as Dynamo's grown, we've added other product lines that look and taste and feel a little bit more institutional for those borrowers that still want an institutional sharp pricing bucket. But it's not our bread and butter. Our bread and butter clients are the ones that want to see a full equity stack or a full capital stack from us. And we're very happy in that. That book performs so well. We've done over $100 million in originations since we started. And we've foreclosed or worked out less than 10 properties in our entire book of business, which is a really big deal for us. Too easily does hard money, private money, mob money, whatever you want to call it, turn into loan to own and loan sharking. We refuse to be that. Like I said earlier, we really are an altruistic debt fund with a genuine desire to, help our borrowers and provide successful outcomes. Ultimately, what we sell is scale and successful outcomes. We just happen to use bridge loans and DSCR loans to get that job done.
Perfect. Matt, this has been great. How can people find out more about Dynamo Capital, and if they want to they want to utilize the loans? Do you have opportunities as well for folks to be able to and be kind of on the other side of the coin and invest with you or through?
Yeah, absolutely. The rate that our team's bringing in deals, we'd love to have the second half of that a little bit stronger. We'd always take in more capital. Go to dynamocapital.com. You can submit an inquiry for a loan. You can submit an inquiry for more information about the fund. Happy to talk about either of those with anybody in depth. I try to stay out of the day-to-day originations. My partner and I have stepped away from that so we can remain good fiduciaries of the fund. But depending on where the loan request is, we'll divvy that up to our team and kind of walk you through that process. But always excited to have a conversation about any of those pieces of the business. And anybody who wants to learn more, reach out. dynamocapital.com, or you can email me directly at matthew@dynamocapital.com.
Perfect. How about any advice you'd give somebody who's maybe just starting out in their investment journey?
Yeah, starting out in investment is difficult. I think it's all about the right partners, understanding what the incentives that those partners have. If you're going to specifically invest in the real estate business, I mean, understand how active the real estate business is. I think a lot of people, this conversation I have all the time, a lot of people get into the real estate business because they want mailbox money, passive income, all that stuff. But they don't realize how many times a toilet clogs. I now with 3 kids, and how much toilet paper gets shoved in them, understand how many times toilets clog. And if I'm a property manager, I'm answering those calls. And if you want to outsource that to somebody else, then your returns are going to go down. So that's a decision that you have to make. And it's not all rose-colored glasses. There are problems and things that pop up in the real estate business. I always ask clients, I was like, how many doors don't close all the way in your home today? Right? How many things don't work in your house? How many faucets are leaky? Okay. Now, if you got a portfolio of 10 of those houses, put a 0 on the end of all those numbers. So that's a shameless plug and pitch for the fund. The fund provides genuinely passive income, but exposure to real estate, for the borrower, for the investors who are done swinging the hammer themselves. But if you get, genuine happiness from being the operator and, providing meaningful homes that are renovated and nice and, provide, your family security from an investment perspective, then I think real estate's beyond rewarding. It's, I think, mostly rewarding because of the amount of work you have to put into it. And that's what matters. But but focus on good partners. Don't rush into things, all those basic things that you'd say, but also just take the first step because you can overanalyze a deal and talk yourself out of a good deal.
No, perfect. All right. We got one last question for you, Matt, and then I think we'll wrap it up and call it a show. How about a book recommendation? Doesn't have to be real estate related, certainly can be something you've read that's been impactful.
Sure. Admittedly, I'm not a great reader, but I did hear Matthew McConaughey read a passage out of his book. Admittedly, I went out and bought the book. It's sitting on my desk collecting dust at home, but I'll get to it eventually. But he read a passage called Tips Included. It was a poem that he wrote in his newest book, Poems and Prayers, by Matthew McConaughey. Very good. You can find it on YouTube. But it's that would be the recommendation. I think it's good. It's all about going the extra mile and doing the work as opposed to getting kind of lulled to sleep and not having the actual experience of earning that tip.
No, perfect. All right, great recommendation. Yeah, I did read his Green Lights book, which was and somebody else had mentioned that he had another one that came out, so I'll have to check that out.
Green Lights also sitting on my desk. I bought both, but
okay, it's a good one. It's a good one. All right, Matt. Hey, this has been awesome, man. Really appreciate it. I think we'll call it a show. Thank you so much for being on the Wealth Flow.
Keith, thanks for having me.
Absolutely. All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love more than anything else to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.